What if the thing that kills a perfectly good real estate deal this year isn't the interest rate, isn't the market, but an insurance bill the borrower never saw coming? That's exactly what's starting to happen, and most investors aren't even aware of it yet. Hi, it's Mario and welcome back. This week I want to talk about flood insurance. Specifically a change that FEMA made that's quietly creating a new layer of risk inside real estate portfolios right now. So here's the backstory. FEMA rolled out something called Risk Rating 2.0. And what it did was change the way flood insurance gets priced. Instead of using broad flood zone maps, they now evaluate each property individually. Distance to water, elevation, historical flood data, replacement cost, all of it. Sounds more accurate, right? And it is. But here's the consequences nobody warned homeowners about. A lot of properties were massively underpriced before. And now premiums are catching up, fast. They're taking double-digit increases, year after year, in many markets. And at the same time, the flood maps themselves are being updated. So properties that were never required flood insurance before are suddenly being pulled into mandatory coverage zones. Now here's where it gets really important for investors. Because this isn't just a homeowner budgeting problem. This is a loan performance problem, and it plays out in a very specific way. A property gets remapped, flood insurance becomes required, and that premium hits, and it's higher than the borrower expected. They struggle to absorb it, especially when you stack it on top of rising property taxes, homeowner association fees, and everything else going up right now. They let the policy lapse. The lender steps in with what's called forced place insurance, which is even more expensive and provides less coverage. The monthly payment spikes, and now a loan that looked completely fine is in trouble. That's the sequence, and it's absolutely showing up in certain markets. But it tends to hide inside escrow adjustments, so it doesn't look like a problem until the loan actually is in distress. If you're buying or holding notes, especially in Florida, Texas, Louisiana, or other coastal markets, this needs to be part of your underwriting process now, not later. The questions you want to be asking is, has this property recently been remapped? Is flood insurance already required, or could it become required? What's the current premium, and what direction is it heading? And is this borrower already showing signs of financial strain? The investors who understand this and how the mechanism works will be the ones who catch it before it becomes a problem. The ones who don't usually find out when the loan stops performing. I'll keep breaking down risks like this every week, and stuff that doesn't always make headlines but absolutely affects your portfolio. And if you're not already on our list and getting the Ritual Notes newsletter, that's where I share stuff like this every single week. What's shifting in the market, what risk to watch, and how to think about it as an investor. It's free to subscribe, the link is down below, and I see you next week.